A very rough week for Wall Street. Stock prices sold off. It was a cocktail of bad news, from tariffs to interest rates to a fiscally reckless spending bill and more turmoil in the special counsel investigation. All taking a big toll on your investments this week. Mario Gabelli joins me right now. He's the founder, chairman, and CEO of GAMCO Investors, a firm that currently has more than $40 billion in assets under management. And Mario, it's always a pleasure to see you.
Maria, great and a privilege to be with you.
Thank you so much for joining us. So what do you think about all of this? We had worries over these tariffs against China, the aluminum and steel tariffs, 700-point sell-off on Thursday, partly because of that spending bill.
Well, it's about time we have volatility. Look, we step back and we look at the global economy, $85 trillion, all running up. Europe is improving. The United States is improving. Japan and China are doing well. The United States is 25% of the world. So the consumer has a net worth close to $100 trillion. Now, the only negatives are in that number are student loans, which are about $1.4 trillion, and auto loans. So we'll have some air pockets. And investments are going to do quite well. So the economy is going to be strong, Maria. I think it's going to be up at least 3% real for the year. I think inflation starts picking up. So we have good growth in earnings. And more importantly, when we step back, the tax package is still being worked through. Corporations are benefiting from a lower rate, but there's also something else. Territorial tax, not a global tax, which means companies are going to start locating in the United States, less barriers. So the economy is good. So what's the market worried about?
Right.
Tariffs? Yeah, I grew up and I remember reading Ricardo, The Comparative Advantage. I remember reading about that was good, the negatives of Smoot-Hawley in the 1930.
That was the negative. That's what people keep bringing up.
Well, there's good, bad, and then there's the practical. The practical is that we have a trade deficit, Maria, of almost $500 billion. We export $1.2 trillion, but we import $1.7, and we are giving money out to China, and part of it is unfair. So you now have an arm wrestling going on, and I think that's got to work its way through the system. But like the Pavlov dog, they just react to the 1930s and when that happened. So we'll work our way through that slowly. And, the Chinese have to come up with certain issues with regards to intellectual property. For example, you can't import more than X number of movies into China, and then they're censored and, whatever.
Exactly. Well, it's not just that. I mean, if you want financial services, your industry, you want to go have a firm in China, you're never going to own it out now. You have to own it 49% of a joint venture. So
you got to start somewhere. I'm not as too concerned about that.
Okay.
Independent of all of that, that's the tariffs. The taxes are really good.
Yeah, that's a good part of the story.
Less regulations working their way through the system. The consumer's feeling good. Wages are rising. Jobs are increasing. And, we just have some structural unemployment issues, but we'll solve them.
So would you see this 700-point sell-off earlier in this week, Thursday, as a buying opportunity?
No, I just think it's part of the old normal in the market. Markets go up and down. And so you just take that into volatility. So you have earnings, and then you have the multiple to earnings, and that's a function of interest rates. And what Jay Powell did the other day is say, we're taking and draining the amount of liquidity we put in the system. Draghi is going to do the same thing. Kuroda is doing the same thing in Japan. So you're going to see more of that. So you have a monetary headwind and rising interest rates. And so that has an impact on the multiples. Secondly, companies' valuations got a little high. And the question is, are they going to be sustained at this level, or are they going to come in? I am in the camp that says they're going to come in, because I can't assume they'll be there 5 years from now when I have to put values on my companies that I follow and what I do bottoms up.
Right. Well, let me ask you this, because as they go up, you're still talking about earnings expected to be up this year by 18.5%. S&P 500 earnings expected to be up 18.5%. Is anything impacting or changing that growth story in earnings from your standpoint?
No, I think you have, the oil patch is going to do well. The financials, even though the yield curve has flattened out a little bit. In addition to that, you have the pound today at like 141, the euro 124. So there's earnings that are non-U.S. are getting an extra tailwind. So the earnings are okay. Then I have to look in as the market discounts 2019. And unfortunately, you got a little election coming up in parts of the world. I think you just had one in Russia, a free market. Yep. China had a free market election. And we basically, you always worry about, will there be a change in some of these dynamics?
Right. Free market election in China. He's going to be the president for as long as he wants to be. And it looks like that's where Russia's going as well with Putin. So
it is what it is.
It is what it is. Let me ask you this, because you mentioned Jay Powell, the Federal Reserve. I laugh when people start getting nervous about 3% on the 10-year and 1.75% on the Fed funds rate. I mean, yeah, they raised rates a quarter point.
Well, from the consumer's point of view, if I'm buying a house and it's a 0.5% more and the average mortgage is $200,000, that's $10,000 a year, that's $200 a week. It has an impact at the margin, and that's what it's supposed to do. But rates have been so low so long, and we, have to get back there. And the $4 trillion that were pumped into the system has to be withdrawn at a faster rate. So we have to get more financial flexibility to the Fed, and that's what they're doing. I'm not too concerned. The only thing that will happen is that the headlines, when you go to 3 or 3.5% on the 10-year, is going to say, wow, it got a huge headwind for the present value of the future stream of those earnings, and what does it mean for stock prices? So
bottom line is, you feel good about the backdrop for investing today.
Oh, I love volatility. So that the algos, the NMOMO, the momentum investors, the algorithmic trading, and the ETFs that are being bought by mindless investors, yeah, they're going to step back and say, whoa, it's not one way. And the volatility is good.
You like volatility, but even the backdrop in terms of earnings growth, in terms of economic growth, you're looking for 3.5%.
Well, more importantly, that let's reinforce. If I'm in the rest of the world, what I like about the United States is the rule of law, a more favorable tax system, a more favorable regulatory environment, and a market system with all of the speed bumps and all the problems and all the potholes. Still is a very good place to invest.